Welcome to In the Black with Erica Black. On today's episode, we will discuss the DC housing market. Is now a good time to buy?
Well, thank you so
I will
much for
have
joining
Chris
me.
Boston with
I
Fitzgerald
see quite a
Financial Group.
few people in the room. Today I'm going to have Chris Boston, and he's going to give us a market update. So where is everybody from? You're welcome to put that in the chat, or you can give me a shout out right quick before we get started. Hey, Natasha.
Hey.
Any shout outs? Where are you guys calling in from?
Calling from Maryland.
Maryland's in the house. Okay.
Calling from DC.
DC. All right. Thanks for calling in. Oh, hey. Hey, Matt. Greenbelt.
Greenbelt.
Hey, Erica, I'm from down south.
Down south. Hey, Layla. So I'm gonna get ready to get started. Chris, if you can give us a little bit of information about yourself. I'm gonna mute everyone at this time, but if you have any questions, please put them in the chat box so that we can get to them.
Great, thank you, Erica. Can everyone hear me?
Yeah.
Awesome. So my name is Chris Boston. I am a loan officer for the Fitzgerald Financial Group, which is the division of Town Bank Mortgage. I have worked for Town Bank for about 11 years, have been in the mortgage industry for about 21 years. So I have gone through not necessarily a pandemic or crisis like this, but years ago, I don't know if most of you remember the housing crisis that we went through several years ago. So I've definitely witnessed and gone through a lot of this. Eric and I will both be talking about opportunities that are present even in the midst of crisis. So the one thing that I just really take pride in is really, I'm not here to sell anyone on a loan. I'm more here as an advisor or consultant, letting you know what options are available for you, whether you're a first-time home buyer, repeat home buyer, or a real estate investor. Town Bank, Fitzgerald Financial, we provide all types of loan servicers as far as first-time home buyer programs, those who are looking to just repeat buyers. We have conventional FHA, VA, USDA. So most of the loan products that are out, we are a full spectrum lender. So we do everything in-house. We're a bank. I'm not a broker. So we do underwrite, originate, and process and close all in-house. So just glad to be a part of this call. Thank you, Erica, for allowing me an opportunity to partner with you on this call, and looking forward to hearing more questions that you all may have, and anything that I could do to assist in that. So.
Okay, well, thanks so much for that introduction, Chris. So for everyone that does not know me, my name is Erica Black, and I appreciate you tuning in to In the Black today. So I'm a real estate professional. I am ranked #1 in the region. I'm in the top 1% in the Mid-Atlantic region, and top 5% in international sales for Coldwell Banker. So that's just a little bit about me. I'm also on the DC Real Estate Commission. At this time, I'm gonna have Chris to go into letting us know, like, what's the market like? How are things going?
Yeah, so the real estate market is, well, I'll speak from the mortgage side. I know right now there is a lot of uncertainty, issues with consumer confidence, but I will say this, and I mentioned this earlier about really the opportunities. Interest rates are, I don't even want to use the word historically low, because I've seen rates as low as below 3% on a 30-year. So we're definitely seeing a lot of good things, good trends, even in the mortgage rates, as far as, creating, with the interest rates being as low, that could give you a lower payment in regards to having a higher interest rate. So definitely, interest rates are just remarkably low right now, which for anyone that's looking to buy, you can take advantage of those rates. There's still loan programs that are available. The first-time homebuyer programs are still available. Your conventional FHA, VA, those products are also still available. There has been some tightening in guidelines, not as much as to the point where lenders are not lending or banks are not lending. But I would say that right now, a lot of banks are looking at credit scores between 640 to 660, just because of some of the forbearances and things that have been occurring. They've tightened some of their guideline requirements with that. But again, if you are considering or thinking about buying a house, with the way rates are right now, it would definitely be a benefit to you. We don't know how long rates are going to remain this low. It could be the rest of the year, depending on more data and technicals that come out. But the one positive outlook out of all of this is that it has definitely positively impacted interest rates, so that anyone that's looking to buy, you have at least a great opportunity with rates to take advantage of those. Whether it's a 30-year, 15-year, or 20-year, you're definitely going to see a great rate. So
when you say the interest rates are pretty low, what rates are you seeing right now?
Right. So right now, I'm saying that I've seen them in the low threes. I've even seen them as low as 2.875, 2.75. So when I say low, I mean below 3, sub 3. So they're that low. And then the other thing that I think a lot of my clients are also looking at is the benefit of buying down the rate with paying points. So you can basically have the option, even at paying an additional cost, which would be a discount point, closing cost, which is a discount point. I don't want to eat up too much of our time about talking about closing costs, but you do also have the option of buying down the rate. So say, for instance, your original rate may be 3.125% with 0 points. That means there's no additional cost tied to that loan, but you may have the option of buying down that rate to 2.875 at a half of a discount point, which would be a half a percentage of the loan amount, whatever the total loan amount is. And you can kind of do the math with that. So just again, looking at even having that option available to you in this climate, whereas maybe 4 months ago, or maybe not 4 months ago, maybe December, November of last year, you saw rates higher, or you saw actually high peak even in February where rates were up in the 4s. So, there's been this roller coaster. But right now, this is definitely a great opportunity for taking advantage of those rates.
Okay, I appreciate you sharing that about the rates. We do have a question that came into the chat. Someone wanted to know, as far as the first-time homebuyer programs, are they all income restricted? Can you?
I'll kind of demystify some of the stigmas out there. So the first-time homebuyer programs, like your DC Open Doors, your DC HPAP, your EHAP, Maryland Mortgage Program, a lot of those programs do have income limitations to them. So you cannot make up to a certain amount of money to qualify, because these are bond programs where they're federally funded, and so they have to make sure that the money that's being presented and appropriated is within a certain income bracket. But there are programs like FHA, which is a popular program that I think sometimes people think, well, FHA is a first-time homebuyers program. It's not. It can be there's no income limitations for an FHA loan. So an FHA loan may require only a down payment of 3.5%, So for someone that's looking to get in for the first time, 3.5% may not be as much as, say, 5% or 10%. You know, there are other programs as well, but I know the Fannie Mae equivalent to FHA, which is the Home Ready program or the Home Possible program, those programs also have income limits. So a lot of the down payment programs, well, a lot of the programs that require the least amount of money down do have income limits to them. But FHA would probably be, if you're looking at the least out of pocket as far as down payment, that would be probably the best product if your income is above the income limit programs.
Thanks, Chris. I
Yeah.
appreciate that. So in regards to these programs, you said that the credit scores have slightly gone up some for them. What was the
Yeah.
credit score on that again?
Yeah, so it varies. I mean, for my bank, and I'm just speaking just for Fitzgerald Financial Town Bank, right now for FHA loans, we have a minimum credit score requirement of a 660. Now the Maryland mortgage program, if you're buying in Maryland, 640. So those two right now are where we currently stand. And a lot of reasons why the scores have changed some, because I know before FHA was 620 or even below, but because of the forbearances and the unemployment claims and the pressures that have come about that have kind of put banks in a more difficult situation, the credit requirements and standards have increased just for a season. And I don't know how long this is going to be. It may be, you know, we're getting information that comes out weekly, monthly. So some of these guidelines could relax some, but I would say right now, for Town Bank Fitzgerald Financial, our current middle credit score is 660, but for the Maryland mortgage program, for bond programs, 640. So if you're using some of the bond first-time home buyer programs, then the 640 would be the minimum credit score requirement.
Okay. We do have another chat question in the chat. We have Matt. He said that he is interested in selling their current home to get the down payment, and then they wanted to know how's the market as far as selling. So I'll speak to the selling portion. In regards to that, with the interest rates being so low, my clients that are looking at the current moment, all of them are running into still multiple offer situation, because what we're running into is a supply versus demand. And so there are sellers that are on the fence and they are afraid, so they're not listing their home. So the buyers that are looking, it creates a situation where there is a bidding war. So it's still, even though we're going through this pandemic, it's still a seller's market, believe it or not. I just had a client, well, all my most recent clients, all the houses that they've submitted offers for have been multiple. There have been multiple offers on those homes. So in regards to selling your home, now is, if you are interested and you're in the market, it's still a great time to go ahead and list your home. I have some listings that are coming on soon. In regards to, we are having to do things a little bit differently because of COVID-19. There are a lot of virtual showings that are occurring. And so what that means is we're having video footage of your home. Some sellers are going ahead and doing a walkthrough with their iPhone and providing it. Also, buyers are, if a floor plan is available, they're wanting to see the floor plan. They want to see as many pictures as possible. Some people are at high risk for COVID-19. So I have clients that have that are currently on the contract that have not seen the house in person. So if we can get as much information as possible on your home, it's definitely a good time to move forward. In regards to purchasing your new home, we won't have a problem with selling. And Chris just mentioned that the interest rates are at an all-time low. So we won't have an issue also with getting you into a new place and getting that down payment from the sale of your home. So I hope that answers your question, Matt. Do you want to add to that, Chris, at all?
Yeah, I think what I'm, did someone else?
No, just you.
Okay. No, what I think I'm seeing a lot now is clients that are going in non-contingent, and maybe you can kind of talk about that, Erica. Non-contingent meaning that, well, I guess if you're needing the money from the sale to buy the house, then it could be contingent. But in certain cases, if you did not necessarily need the money for down payment, you could go in at non-contingent, meaning that we would have to qualify you carrying your existing home mortgage and then also carrying the new home mortgage. And then that may make your offer more competitive. But in your case, if you're looking at using that money to go towards the down payment, we could do a simultaneous close where one transaction settles in the morning and then the next transaction. So the sale of your home happens in the morning and then your sale on the new home that you're buying happens in the evening or the next day, depending on, the time frame. And then one other thought that may be an option is if you're able to qualify non-contingent, where you don't sell the home the same time, but you're able to qualify carrying both mortgages. Once you do sell that home, then the proceeds can then be applied to the new home, and you can do what's called a recast, where they reset the amortization based on that principal reduction, and then you can get your payment adjusted that way at that time. So you have options, but it's really going to be each individual's, just looking at the benefits of either or, and then making sure that you're comfortable with whichever option makes sense for you.
Okay. Thanks for sharing that. I want you to, if you could elaborate a little bit more on you. You've been in the business for a while, and so during the last market crisis, what impact did you really see in the DMV? Because what I noticed is that we weren't impacted as much as like a California or like Florida. Like some areas were devastated in our area. So if you could speak a little bit about that, because I know a lot of people, they're on the fence because they're like, oh, I don't know if I should buy, because am I going to buy this house and then it's going to be worth less, or what have you. But can you speak to that? Because I know right now it is still like all the reports, everything that's coming out is still showing that the DC market is a steady market and we're still moving forward and we haven't been impacted. So I just want to know if you can speak to the last time that there was a crisis for anyone that's involved in this.
Yeah, I think the one thing with this crisis that's different than the last crisis, this is a healthcare crisis. This is an issue with healthcare, where we're dealing with a pandemic because of a virus, whereas the previous crisis was a housing issue where there were exotic loans, mortgage interest rates that people were getting into, misinformed. It was just the mortgage crisis or the mortgage meltdown that happened before kind of created the problem. A lot of bad loans, a lot of bad banks, and so people were put into products and situations that they should not have been, which resulted in disaster. In this case, people are more informed about what they're getting, the guidelines, the regulatory issues, the accountability that banks have to abide under you're getting it's a vanilla loan nowadays. I mean, there are some products out there that may not be there, but most loan programs for first-time home buyers, repeat buyers, and investors, going into the transaction, at the settlement table what you're getting. You're very informed and educated on those products. So I think the state of the buyer in this case is a little different than how it was when we went through the housing crisis. So because of that, we will get through this situation. I think the key is going to be those who take advantage of the opportunities that even present themselves. And I get it, there are certain people right now that aren't working, and that's unfortunate because that's, we're all in a state of, there's a lot of challenges going on right now. But if you are able to see the opportunities, even in this market, whether it's in DC, Maryland, or Virginia, you will definitely come out of this whole crisis on top, just because this is not a financial crisis, this is a healthcare crisis. And so the markets will recover over time. And when they do recover, those who did take advantage of it will definitely see the benefits or the fruits of it.
Thank you for elaborating on that. I don't know why it's an echo. Can you hear me? Okay. Yeah, thanks for elaborating on that. I know during the last market downturn, I actually purchased the house that I live in. And so the fruits of my labor is definitely paying off. And I know that you said, since the interest rates are so low as far as supply and demand, so if you think about it from an economic standpoint, if the market now, let's say, so the interest rates are lower and the houses, for the most part, the housing prices haven't really plummeted. Like they're still pretty steady. And I just put an article in there from NPR in regards to our market. It says, the whole title, it says DC area housing market remains strong despite the coronavirus outbreak. So supply and demand, right now we have limited inventory. So it's still, that's why it's creating that whole bidding war situation for buyers. But then there are some opportunities where if the seller does overprice their home, because you have to still be realistic with the market.
Mm-hmm.
So if you don't want to put your house on the market for 50, 100,000, you want to put it on there based on what the comps, what the comparables are going for, and it will go ahead and sell and move for buyers that are in the market and are interested. But in regards to that same house, that's from the seller's perspective. But for the buyer, if Chris is saying that the interest rates are now less than 3%, you're getting that house cheaper than if the interest rate was 4 or 5%. So the higher the interest rate, the less house that you're going to be able to afford. And can you elaborate a little bit more on that, Chris? Because I know you're the numbers guy.
Mm-hmm.
How the interest rate and that amount and that number impacts how much you can afford.
Right, and I think just to kind of look at again, because I know you had talked about just comparing this crisis with the previous crisis. The reality is with rates where they're at now, these are for 30-year fixed mortgages. So we're not talking about 5-year ARMs or 2-year ARMs or 1-year exotic hybrid mortgages where people were getting into in the previous crisis, where you had a rate that maybe started at 3%, but for 5 years it was locked in at that. But after the 5th year, it adjusted to say 6 or 8%. These are loans where your rate is locked in for 30 years at 3%. So the stability in the payment, the stability in the rate, the stability for you knowing that that payment won't adjust based on the note is in itself a huge benefit than what we dealt with, previously. To your point, Erica, about just looking at how interest rates impact, I mean, the principal and interest payment is based on the rate. So if you have an interest rate of, say, 2.875 or 3% versus an interest rate of 4%, you're going to have a lower principal interest. Of course, it makes sense. You're going to have a lower principal interest payment at the lower rate. So because the payment is lower, it gives you the ability to qualify for more house because the payment is lower. Whereas if you were buying a house, so for instance, if you're buying a house at $400,000 and the rate is 4%, the payment's going to be higher than the $400,000 house at the rate of 2.875%. I'm not trying to get too deep into numbers, but long story short, if you have a lower rate, you may be able to qualify for a house of $425,000 based on 4% at $400,000. So that's where you to your point, Erica, is that because you have a lower rate, it does give you the ability. If I had my mortgage calculator, I could do it, but I don't want to eat up into our time, because I could give you real numbers, but you could look at the same payment for 425 and 400 based on the difference in having a lower rate.
Yeah, so you can. Thanks for sharing that, Chris. So you can either get a house that's a little bit higher, or just go ahead and move forward at that lower amount and have a lower payment, and put that money, because last week we talked about saving. So put that money towards your saving. So that means you're basically being able to buy a house cheaper. at this moment if you were to move forward. So I know Donna, she said that she is working with the HPAP program, and she said she may want to wait until all the smoke is clear to see if, because she doesn't want to buy a house that may be worth less later. But I haven't seen where that has been the case for DC. She is doing HPAP, so that's the DC market. I haven't seen where. What about you, Chris? As far as purchase a house in DC and it being worth less later if you bought a smart investment.
I mean, I think to you, well, you said something that's key is smart investment. And I think, the one thing that we still don't know, there's still a lot of uncertainty. There's a lot of uncertainty that's brought about by this virus, and how long, people are going to be not working, how long will the markets be where they're at. But I think if you have to look at your objective in anything you do, is this a short-term goal that you're trying to set, or are you looking at long-term goals? DC is a very strong market, period. And so even if you did experience a slight dip in price because of this pandemic, over the next 5 to 10 years, again, you're talking about buying, look at the stock market. If you're going to buy low, this is now the time to buy low. I know the inventory may not be the same with real estate as it is in the stock market. I'm not comparing the two, but the opportunities that are presented now, whereas when everyone's back to work, summer is hot, everybody's foot traffic, now you're getting multiple bids, 20 offers on one property, whereas now the foot traffic is not that way. Like you said, Erica, supply and demand, the demand sets the price. And so if you've got 20 offers, whereas now you may only have 5 offers because not a lot of people are out watching and looking at properties. So I don't know, I guess I'm not a genie. I can't really say, will the prices dip in 5 years or 1 year, but I can say that right now, the amount of attention that is given to real estate is not as it would be if we were in a real springtime, a real spring fling, as I would say.
Right. And I'm gonna send the market report over now. So basically what it's showing, and I'm gonna send this chart over. So in our market, our market has improved since last year. Let me find, I'm gonna send this, I'm gonna put this, I'm about to drop this in there. So our market has improved since last year, and we're experiencing this corona situation. So I wouldn't want you to sit on the, oh, she said, I understand, thank you. I wouldn't want you to sit on the fence if you can afford to purchase, because by sitting on the fence, that means that later on you're going to buy the same house and it's going to be worth more. So for example, with me buying during the last, yes, it was a situation with the housing market, as opposed to, like Chris pointed out, this is a health situation that we're having. But I was able, from purchasing during that time, I was able to make at least $450,000 from, because it's if you look at it, it's a long game. Like when you purchase a home, you're not buying it to move out in 2 weeks. It's not like Chris said, the stock market, where you're going to be a day trader and it's like, hey, I don't like this house. I'm gonna buy another house tomorrow. No, you're buying it for the long game. So you're for the end game. So you're going to make sure that you make a smart investment. You're going to make sure it's a great neighborhood. You're gonna look at the comps and see how they have been over the past 6 months to a year, however long. I have that information. I can look that up for the neighborhood that you're interested in. And then at the end of the day, you have to, having shelter is one of your primary needs. Based on Maslow. So you have to have a roof over your head. So you want to make sure that you have that roof, make sure you're making a smart investment with that roof, and also putting your family in a situation where you're able to build generational wealth, because that's what real estate can do, and that's what it's done for my family. I know there is another question from Matt. He said, if I was partially furloughed for 2 weeks because of this crisis, would that impact his ability to get a loan?
Yeah, I think the key is going to be how we document the employment. I know right now a lot of banks and investors understand the nature in which we're all under. So if you're furloughed right now for 2 weeks, and then once you're back on the job and everything is back to where it's normal, when you're receiving, I don't know if it's 40 hours or 80 hours, but stuff like that can be explained. But I would say the key is going to be once we all and anyone returns back to just that current or where they left at, or if it's 40 hours a week, 80 hours a work week. But if you can document that, I always tell people oftentimes, they do allow gaps of employment. So even if you were transitioning from one job into the new job, and maybe it took you a month or 2 months to do that, as long as we can document that, oftentimes we can get over that hurdle. So especially in a situation like this where you may be furloughed, but say next month you're back on the job and it's the same job, then that could be something we could probably get around.
Okay. Well, first of all, Chris, I want to just see if you have any like final discussion points in regards to the housing market, and then we'll just fully open it up to questions from everyone in the room. We do have a couple more questions in the chat, but I just want to, see, as far as the highlight, like I know in my case, for the month of April, I closed 5 deals.
Mm-hmm.
I have quite a few buyers that are still, they're on a contract, they're moving forward because they understand the importance of how low the interest rates are and the value of building generational wealth, like making a smart decision and making sure they're in an area where they know that most likely there will be growth. Of course, none of us can predict the future, but housing is one of those basic necessities that we must have. So, why not invest in yourself versus investing into your landlord? So if you are currently a tenant and you're renting, that money is just going to your landlord. It's not going towards your mortgage. It's not, it's not going towards anything that's helping you per se. So that's one thing that I wanted to point out. But you, Chris?
Yeah, I think just be diligent. I think at the end of the day, there's a lot of uncertainty that is out there. And so everyone's situation is different. Should everyone buy? I mean, you've got to look at your situation, look at your budget, and then you come up with you come up with the decision of should you not. But I would tell you this, that there are going to be people that come out of this crisis on top, because there are opportunities. Again, these opportunities I'm not telling everyone that they should buy. I'm just saying that you need to look at your situation, and if it makes sense, and you're not necessarily exercising something out of fear, but of sound mind, and it's like, okay, this is an opportunity. I see the numbers make sense. I'm not putting myself in a situation where it could create a problem in the next 3 months or the next foreseeable couple of months, but there's a ton of opportunity right now, and just where rates are right now, where the market is, and so I'm definitely optimistic about it. But you definitely have to look at your situation, evaluate it, and be diligent. Do your research. Ask people, like Eric and I are having this call right now. But just be educated, be diligent, do your research, run the numbers, and if it makes sense, there's opportunity in it.
So we have questions. So I'm going to ask the questions that are remaining in the chat box, and then I'm going to unmute so we can do some quick questions if people wanted to actually speak, and then we'll wrap up. So Natasha wants to know, what's the minimum income and length of employment needed to be considered? So there isn't a minimum income needed to qualify for a loan. And as far as length of employment, Chris, you can speak more to that.
Yeah, and income is related to what you qualify. So to Erica's point, there is no minimum income, but your income is relative to how much you're trying to qualify in purchasing a home. Some banks will not lend to certain loan amounts, but income, there really isn't. If you're making income, the income allows you to qualify for the loan amount. As far as length of employment to consider, I would say right now most banks want to look at a 2-year history. If you're self-employed, I would say 2 years is typically the time frame in which a lot of banks want to see a history for. If you're a pay stub or a W-2, whereas one, you say you were in school for 4 years and then you graduated, and so now you've just got an offer letter and you start employment in 6 months, something like that we could look at. But I would say most banks want to see a 2-year history of employment just to look at the stability of income and to see just how we qualify.
Okay, a couple more questions. We have Carol on the line. She said, is there an advantage or disadvantage to use a first-time home buyer program versus a program that will make sure you don't have to pay PMI? So generally, just for people that are unaware of what PMI, that's private mortgage insurance. If you don't do a 20% down payment, then you have to pay or you have to pay the PMI. As long as you have a conventional loan, you are able to, the PMI will drop at that 20% percentage. And it doesn't have to take, 10, 20 years to get there. Like if your neighborhood improves to the point where you feel that your house
Thank you for
appraises for that
subscribing to In
20%
the Black.
value,
See you
then
soon.
also you can present it to the bank and that PMI will drop off. There are some lenders that allow you to not have a PMI for less than 20%. Some lenders offer 10% down programs. But Chris, you can talk a little bit more about what your institution offers.
Right, and there's some lenders that will do 100% with no PMI, but the rates may be higher. So you're paying the PMI, and rather it's in the rate or it's in the down payment. But to Erica's point, yeah, PMI is something that private mortgage insurance it protects the investor in the event that you default on that loan. There's some risk that's been assessed based on what they've been collecting in the monthly payment. There are programs where you can pay a single premium up front versus paying the monthly PMI. Those can be at 5% down or 10% down. So in essence, you can buy out your monthly private mortgage insurance by paying an upfront single premium that could be paid for by the seller if you get seller help. It could come from any of the programs. To your question about the advantages and disadvantages of using the programs, even with using the programs, you're going to still either get a conventional or an FHA loan. So you're still going to have to run into the scenario with PMI. Now, I guess the one advantage that you would get with the programs, if you're going through HPAP and HPAP gives you $80,000 and that's 20% for your down payment, then yes, you don't have to pay PMI. But then you have a loan because those loans, it's not a grant. Those loans are now secured to the property. So if you decide to sell your home or refinance, you may run into the issue of having to either pay that loan off or have them subordinate. So yes, the programs are available, but again, a lot of them, there are some grants and you have to determine if you're going to use a grant versus a loan, because the grants tend to have a higher interest rate, whereas the loans don't have a higher interest rate. And then you can go to DCHPAP's website or you can do the MMP website. But as far as the advantages and disadvantages of private mortgage insurance, I think it's going to have to be looked at based on the amount of down payment, your monthly payment, and then the type of programs you use, whether it's putting down 10% or 5% or 3%. So I hope I answered that question.
Yeah, I think that was, so yes, you spoke to the advantages and disadvantages. Of course, I'm not a financial advisor or anything of that nature, but if I had 10 or 20% and it was cheaper for me not to put it down, I know my husband's on the call too, but honestly, if I didn't have to do the 20 and I can just do 10 or 5 and pay that lump sum at closing, I would keep that other 15, 10 to 15 in my pocket because we still are, the market is still uncertain. So it makes more sense for you to have that savings, have that emergency fund, unless you don't need it. If you already have that emergency fund and you have all the money that you know, where you wouldn't have to worry. But if it's one of those situations where it's like, nah, I think I'd rather keep this extra money just as a cushion, because when you purchase a house, there are, you know, home ownership is fun, it's awesome, but, you know, things go wrong, things happen. You know, a windstorm comes through and a shingle flies off, and you have a little leak in the roof, like whatever, any little small thing can happen, and you want to make sure that you have a small cushion. And of course, when Chris is pre-approving you, he's looking at that, but that's the comfort level that the bank is saying that you should have. But beyond that, there may be a certain amount that you feel more comfortable with having in your bank account. So I honestly would not put that much down if I did not have to. So then there are a couple more things. I don't know.
Can I just add this one point? I think to your point, and even just looking at the monthly savings, I've run scenarios where to buy out the PMI may have costed, say, $8,000 in cost, but the monthly savings was $250 a month. And so if you're talking about staying in this house for 3 or 4 or 5 years, you would have made your money back, even paying that additional cost up front. So to your point, you know, you got to do the numbers and say, okay, if we're going to stay in this house for 5 years or 10 years, you know, if we make our money back after the 3rd year, then in that scenario where if you have that money, or if the programs give you that additional money, then it may make sense over the long term in buying out the PMI. So that's what I meant by as far as looking at the different scenarios. And we could do that individually. Everybody's case is different, but.
Right. So you're saying either buy out the PMI at a lower down payment, like 5 or 10, versus putting that whole lump sum of 20% down.
Oh, no question.
Because you would have that 10%, hypothetically, if you were going to put down 10% and then do the PMI portion as far as buying it out at closing, you still have that 10% in your savings account, and you pay that extra $800 or $1,000 at closing. But you still have that 10% on you.
Right.
So economically, just right now with everything, it makes more sense to do a 5, or, you know, depending on, you know, some people want a certain amount as far as their monthly payment. If that's the case, I know my mom recently purchased a home, and she just was stuck on, like, I don't want to pay past this amount every month. So it's like, okay, if you don't want to pay past this amount, then you would have to put down this amount. But if that's not the case, it makes more sense to hold on to your money. So do a 5 or 10% down, buy out the PMI for that $800 or $1,000 or whatever Chris or your lender quotes you at, and keep that other 10 in your pocket. So then we have a couple more questions. How do student loans factor into your loan qualification? What's the recommended amount to save towards your down payment? So Chris, do you want to speak to that? Because student loans is captured as debt.
So it varies by program. So for instance, with conventional loans, they look at, because student loans, some people are in these income payment plans or income driven plans where you have this low payment based on the amount of student loan debt. So as long as we can verify and document that, and I'm speaking specifically to conventional loans, as long as the payments can be documented rather on the credit report or through a credit supplement, we can use those payments in qualifying you. Now, the days have gone where, where a lot of the guidelines said that the student loans were in deferment for over 12 months, then we did not have to include those payments in your debt to income ratio or your qualifying ratios. But again, what it created was long-term banks were qualifying people based on no student loan payment debt, and eventually them having to pay the student loan debt, now putting them in a financial hardship. So most investors do look at, for conventional loans, what's currently reported on the credit report, or what supplement we can get to show what the payment will be or what it is. For FHA, it's a little different. They take either 1% of the student loan balance, which can be a lot. If you got a $100,000 student loan, 1% of that, I mean, that's a lot that could impact your ability to qualify. Or they look at what the amortization payout period would be for that student loan. So if you've got a student loan that has a 30-year term on it, so you'll pay it off in 30 years, does the payment that's reported on the credit report pay off that student loan in 30 years? And that's how they go off of. So it just depends on FHA versus conventional. Conventional tends to be a little more favorable for people who have student loan debts. But again, the credit score requirements may be a little bit higher with conventional than it would be with FHA. So we'd have to look at both scenarios. But yes, to your point, we do look at the payments that would be for the student loans, whereas before they necessarily didn't.
Okay, so we just have 3 more questions and then we're gonna wrap up, Chris. Thanks for everyone that's still on the call. This is a really great conversation. It's just a lot of details and a lot of information. So thank you for hanging in there. So another thing that Natasha wanted to know is how much do you recommend saving towards the down payment? Because you have your down payment and closing costs. So what percentage would you save to that, Chris?
Yeah, I mean, again, I'm one that believes you want to have reserves. Erica, and I both know that when you buy a house, there are things that come up even after you close. And so I think it's important that as much as you're saving up for down payment and closing costs, you also want to have some money left over for reserves. I say 2 months to 3 months of whatever your loan payment is would be recommended. But is that always the case? No. As far as down payment, it varies based on the purchase price, I think. And then again, even with the purchase price, that could vary. I'm not trying to dodge the question, but 3%, 5%, 10%, the rates actually for the 3%, 10%, or 5% may not even be that different. So you may even get the same interest rate putting down 5% and putting down 10% or putting down 3%. So the question then is, if you're trying to get your payment as low as possible based on that purchase price, then of course, having more money for down payment would definitely be the preferred option. As far as closing costs, it varies based on area. I think in DC, the down payment could be, the closing cost could be 4%, 4.5% based on the purchase price. So say for instance, if you have a down payment of 5% and then you need to factor in your closing costs, if you're not getting help from the seller, then maybe factor in another 4.5%. So in essence, you may need 9% of the purchase price, 10%. So it varies, but I would say if you're looking at maximizing and getting the lower payment, you definitely want to have more money available. And then closing costs, Erica, you can maybe speak to as far as the sellers contributing in certain markets versus not. 4.5% tends to be the average. In some areas, maybe more than that. But again, that would be something that you would need to prepare for if you're not able to get seller help in addition to the down payment.
Yeah, so with the supply demand situation, unless the house has been sitting on the market for a while. There's multiple offers. Most sellers are not really contributing to closing costs. So what a lot of my clients are having to do is, if the house is, for example, listed for 350 and they need 10,000 in closing. Well, for some people, they don't even need the 10,000. It's just they don't want to get the 10,000 out of their savings, and they want to wrap it into the loan. So then they would offer 360 and ask for 10,000 back from the seller. So that's one way to work around like having to bring less money to the table. There is another question or two, but I wanted to hear the people voices. One person asked about buying down the rate with HPAP. I know that you can buy down your rates for sure with usually any program, right, Chris?
Unless it's a bond program where the rates are set. So the Maryland Mortgage Program and the DC Open Doors, their rates are set. So you can't buy down those. But as far as like HPAP, where you're using that money specifically for down payment and closing costs, or EHAP if you're a DC employee, or FHLB, which is another product, those programs are just giving you the down payment assistance or closing cost assistance, in which you're getting that loan through that bank or that investor, so you can actually use that money to buy the interest rate down.
Okay, it looks like Ronald has a question. I'm unmuting everyone. If you have any questions, you can speak if you like.
Yes.
Okay, Ronald.
Yes. So I just had a question as far as, so the programs that they were speaking of, FHA, the other ones. I'm currently in the market, as you know, and one of the lenders was kind of saying that because of what we're going through right now, that they've suspended some of the programs. So not suspended, but I guess like right now they're not really offering those programs, and just wanted to know if maybe Chris could speak to that. And then I had another question.
Some programs right now that have been suspended. The FHA program is still, and again, I can't speak for every lender, but the FHA, and I'll elaborate to your question. So there are two different types of FHA loans, and Erica talked about when she bought her home originally. I think you used the FHA 203K.
Yes.
So the FHA 203K, which is a renovation loan product, I know we have suspended that for right now. One of the reasons is the risk is greater for a renovation loan than a regular loan. So FHA has a regular FHA loan, and it has a FHA renovation loan, which is the 203K. So a lot of the renovation loan products that I've seen on our end have been suspended, just because of the higher risk in doing the loan. The permits, a lot of the offices are closed right now, or the delay in getting things done. So the process is a little more tighter than it would be in the event where we weren't running through this. But as far as regular loan products, the Maryland Mortgage Program is still open and available. HPAP, I actually received a letter from a client the other day, her notice of eligibility, so that's still open. Conventional loans, as far as and I'm speaking more of the acquisition loans, the loans that just are giving you money to buy the property, not the renovation loans. But those loan products are still available to consumers.
Okay, thanks, Chris. So one last question, I think. I don't know.
Did Ronald have another question, I think?
Ronald.
I
Go
did.
ahead, Ronald.
It's quick, because I think y'all touched on it already, but it was to the fact of, so the 2%, you saying it was a good market as far as the interest rate. What scenario does it look like for you to better get that 2%? Because one of the lenders were giving me close to the 4%, but it had 100% finances. So trying to acquisition the 2%, would that be a scenario where you're coming out of pocket, you're looking at that 4, 3, 5, 7% down that you were talking about, or is that based on your credit? What are you looking like as a scenario to get closer to the 2%?
You're saying
Right.
the interest rate?
Yes, interest.
Right, just to be clear, I didn't do, there's no 2% rate. 2.875 was what I was saying that. But I would say, and rates vary, so the rates could be different on Monday when the market opens up. But I think, Ronald, you would have to, and I don't want to, we can talk offline too if you want, but I think you would have to really compare the 100% at the 4% rate versus a 97% at, say, a 3% interest rate, and then look at the cost and monthly payment, out-of-pocket cost, and then kind of do a break-even analysis on that. So, you know, the higher the rate, but it's less money out of pocket versus you put 3% in, but you got a lower payment over the longer term. That's what you would have to kind of compare the two and see which one makes most sense.
Gotcha. Thanks.
Yep.
I have a
Great question.
I'm sorry.
Okay, go ahead, Carol.
Okay. So I just did a quick glance at the EHAP program. Is it better to just like jump on that ahead of time? Is it a difficult process? Is it based on income? If you could just tell me that quickly. I'm going to look into it, but is that a good thing to have before? I mean, it looks like it pays closing costs, so I have to have that done before I go to make an offer to something. Is that true or false?
Oh, Eric, as far as making an offer, I mean, I think you're going to want to know what amount you're qualified for. So if you're just using the EHAP program and not the HPAP, so you can use HPAP in EHAP, or you can just use EHAP.
Okay.
So you're using both.
Oh, I don't know. I haven't. I'm like new in this ball game. I'm a little nervous about the whole process, and so I've been working with Erica, and so I'm going to look into the EHAP program, and I guess I should also look into HPAP, I suppose, and see which is best, because I looked at Landed, and now I'm hearing different things, and so maybe you know, I need to do a little bit more investigation into EHAP and HPAP, and I should do them simultaneously. Would that be best?
I would say do them simultaneously, which would be best, because they both you get the money. One is up to a certain amount, and then the EHAP is added to that amount.
Okay.
So it would probably be great to get them both done at the same time, so that once you get, and you'll get 2 different notices of eligibilities from the whoever's facilitating the counseling.
Okay.
But I would say, yeah, I mean, I think they're doing the classes online or virtual.
Yes.
But I would say, yeah, if you can do that, you'll still need to meet with a lender, because you're going to still have to get pre-approved.
Okay.
But as far as the programs, I would definitely get on the schedule to at least get that, so you'll know the amount that you would qualify for both.
Okay, because I have been pre-approved for a certain amount. So, okay, cool. All right, thank you. That's good. Thank you.
So just to piggyback on that conversation, so basically with the pretty much the programs, any of the DC programs, you have to get pre-approved for the DC portion of it, but then also get pre-approved for an authorized or approved lender through the program. So Carol is currently already pre-approved, but we just need to verify in your case to make sure that that lender is on the list. If not, Chris is on the list, if you choose to go that route.
Okay.
Anybody else before we wrap it up? Any other questions in the room? I think that's it. Do you have any closing remarks, Chris?
Opportunity.
Thank you, guys. That was really very informative. That was very helpful. Thank you.
You're welcome. So next week, I'm going to have a session for the moms. So.
Oh, wow.
Yeah.
No session for the dads?
Yes, I have one for the dads. About you guys. So I'm going to put the flyer up in there for everyone that RSVP. You should have a flyer in your email. I see someone, is that another question? One sec. See, one second. Thought I saw a person. Oh, thanks so much. Oh, you're so welcome, Donna. Now, if you have any more questions, please, please, please do not feel, don't feel like you're harassing us or anything. Just, go ahead. We want you to reach out to us and let us know what your concerns are because we want you to be comfortable with, purchasing. This is a huge investment. So here is a flyer. I don't know, can you see it? I'm sharing my screen. So it's gonna be Mother's Day 2020. We're gonna do 5 smart tips for working moms to manage their finances. Again, we're gonna be here Sunday at 1. I'm gonna have Alicia, and she's gonna be, just shedding light on what moms can do as far as maximizing their money for their family. So thank you so much. I appreciate you tuning in. And again, Chris's information is in the contact box. And you can also feel free to reach out to me at any point. My information is on the email that I sent out. Thank you so much for joining. And thank you guys. I appreciate you giving us praises, but thank you for taking the initiative and hopping on this call and getting your questions answered. We hope that you enjoy the rest of your day. Please, please stay safe. Make sure that you're keeping your mask on, your scarf, making sure you're using your hand sanitizer. You're so welcome, Matt. You're so welcome, Layla. Thank you, guys.
Yeah.
But please, be safe, and we hope that you enjoy the rest of your Sunday afternoon. Thank you.
All right. Thanks, Erica and Chris.
Welcome.
Thank you all.
Thank you,
Right.
Cub.
Thank y'all.
Welcome.